Hey there. So you're looking at a stock, right? And the price just seems crazy high. Chances are you were reacting to its PE ratio. Today, we're going to get into a question that honestly trips up so many investors. When you see a high PE, are you looking at a wildly overpriced trap, or could it be a golden opportunity? Let's figure this out.
So let's just cut right to the chase. Is a high price-to-earnings ratio always a red flag? I mean, for a lot of people, the knee-jerk reaction is yes. It's just a clear sign that a stock is way too expensive. But, the truth is, it's a little more complicated than that.
Now, before we can bust this myth, we've got to make sure we're all on the same page. So let's do a super quick rundown of what the PE ratio even is and how it works.
Okay, so at its heart, the PE ratio is just a valuation metric. That's it. It's a tool to help you figure out how expensive a company's stock is by comparing its price to the profit it's actually making.
And the formula? It's about as simple as it gets. You just take the stock price and divide it by the company's earnings per share, or what you'll always see called EPS. That's the whole calculation.
Let's make this real with an example. Say a stock costs 100 rupees a share, and the company makes 5 rupees in profit for each of those shares. Well, you take 100, divide it by 5, and you get a PE ratio of 20. Simple enough, but what does 20 actually tell us?
And here it is. This is the key. A PE of 20 means that you, the investor, are paying 20 rupees right now for every single rupee that the company is earning. And, well, you can see why a really high number here might make someone nervous.
Okay, so if a high PE means you're paying a huge premium for what a company is making today, why on earth would anyone do that? Well, this is where we get to the other side of the story, the part that so many people miss.
Turns out there are two really big, totally legitimate reasons a stock might have a high PE. And it all comes down to two things: expecting huge growth in the future and understanding that every industry plays by different rules. So first up, growth. Think of a high PE as a vote of confidence from the entire market. All those investors are basically saying, yeah, we know the price is high today, but we believe this company is going to grow so fast that today's price is going to look like an absolute steal down the road. You're not buying today's earnings, you're buying tomorrow's.
And this brings us to industry standards. I mean, you wouldn't compare apples and oranges, right? So why would you compare the PE of a fast-moving software company to a stable, predictable grocery store? Tech companies almost always have higher PEs because their potential to scale and innovate is just massive. A grocery store, it's stable, but it's not going to suddenly double its profits next year. You just can't use the same ruler to measure both.
But, and this is a big but, betting on all that future growth comes with a pretty big risk. This is the part every investor needs to get. It's what happens when those sky-high expectations suddenly slam into a not-so-great reality.
This right here is the million-dollar question. That high stock price is being held up by a promise of incredible growth. So, what happens when that growth just turns out to be kind of average? Well, that leads to a thing called PE derating. It sounds like some fancy Wall Street jargon, but the idea is actually super simple. When the market figures out the company isn't the superstar it thought it was, it just decides, you know what, I'm not willing to pay that crazy premium anymore. So the PE multiple it's willing to pay gets derated. It gets lowered. And it's like a chain reaction. The company's growth is just a little slower than everyone hoped. The market gets disappointed, so it lowers its expectations for the future. The PE ratio gets slashed, and then the stock price can absolutely tank. Now listen closely, because this is the craziest part, and it's what trips everybody up. The company's earnings can still be going up. It can still be a good, growing company. But if that growth doesn't meet the market's ridiculous expectations, the stock price can still get crushed. The company isn't failing, it's just not succeeding enough. All right, so if the PE ratio by itself can be so misleading, how are we supposed to get a better view? Well, luckily for us, there's a smarter metric that adds the one thing PE is missing: the context of growth. So look, if you remember only one thing from our chat today, let it be this: you can never, ever look at the PE ratio all by itself. It's just one number. It is not the whole story. And that brings us to our hero, the P ratio, the price/earnings to growth ratio. It's a fantastic little tool that does exactly what it says on the tin. It takes that PE ratio and puts it into context by factoring in how fast the company is expected to grow. And this table right here shows you why it's so powerful. I mean, just look. Company B has a PE of 10. Company A's is 30. So Company B is way cheaper, right? Well, not so fast. When you look at growth, Company A is growing at 30%, which gives it a PEG ratio of 1. Company B is only growing at 4%, which gives it a much higher PEG of 2.5.
And here's the rule for PEG: lower is better. So what this tells us is that Company A, even with its much higher PE ratio, is actually the better deal. You're getting way more growth for the price you're paying. The PEG ratio gave us the context we were totally missing.
So let's wrap this all up. What did we learn? First, a high PE isn't always a bad thing. It can mean investors are excited about future growth. Second, remember, apples to apples. Only compare PE ratios for companies in the same line of business. Third, and this is the big one, use the PEG ratio to see if that high price is actually justified by growth. Because at the end of the day, context is everything.
And I'll just leave you with this final thought to chew on. We've just seen how one number, the PE ratio, can totally mislead us if we don't look at the bigger picture. It kind of makes you wonder, right? What other single numbers in our finances, in our jobs, in our lives do we rely on without ever stopping to ask, what's the context? Something to think about. Thanks for tuning in.